Good afternoon. Welcome to the FIG Securities Smart Income Investment Strategies session. My name's Elizabeth Moran. I'm Director of Education and Research here at FIG. With me today we have Craig Swanger, our Senior Economist. Now Craig's been at FIG the last 2.5 years. What's interesting with our first Smart Income report last year, many of Craig's predictions eventuated, not the least being the revaluation of the Australian dollar. And fortunately, hopefully some of you profited from that strategy of Craig's to invest in US dollar securities. Delighted to have you back here today, Craig. Couple of things a little bit about Craig. He was most recently Global Chief Investment Officer at Macquarie Bank and held or managed 14 teams in various countries spanning all asset classes. So Craig really has a wealth of experience in investing across all asset classes, and we're very, very fortunate to have him here this afternoon. Welcome, Craig.
Thanks very much, Liz. And welcome everyone else. I'm going to, just before we start, do a little bit of just an opening and talk about what the next hour holds in store.
Can I just interject? Sorry, I haven't given my full housekeeping background check. Sorry about that, Craig. We will take some questions today, and you'll see on the right-hand side of your screen an orange arrow. If that's not expanded, can you click on that and you'll see a section down there where you can ask questions. Now, Craig's running off to get a flight to Perth, so we are going to have to finish the webinar at 3:15. So my intention today is just to let him speak and give us all that he contains, those words of wisdom, because that's what we're all wanting. And if we have time at the end, ask some questions. But please type them just in case. So now, formally, I'll hand it over to you, Craig. Thank you.
Great, thanks, Liz. So what I'll do for the next hour is I'll endeavour to get through in 1 hour. If there's some more questions at the end of that, then we'll cycle back round and go through those. But it just means that anyone who does need to get away at 3 can do so. What you'll find quite different about the next hour is really the style that we prefer to use here, where firstly we're going to be quite specific about different, say, forecasts or views on what the world's going to look like. And you often don't get that, and I find it quite frustrating when some of my peers will, they'll talk about market overweight or underperform, and quite vague terms that for real people don't really mean anything. So when you hear me talk about views on where the market might be, whatever that market might be, equities or bonds or whatever, don't be surprised if I get very specific around numbers and what my precise view is. Of course, that is just my view. And that's the second most important thing for understanding the next hour is, my strong preference when doing these sort of seminars is to share, not tell, and to really help people understand, as opposed to just take lots of dot points about what might be something that's worth buying or not buying. And the reason I do that is the way I look at investments is really, it's the same as running a business. And actually, knowing most of the FIG client base, the vast majority of you have either run your own business successfully or run someone else's business successfully. And in order to do that, you would have had a business plan. And normally when you do a business plan, you seek the help of advisors of various types, whether they're accountants or consultants or whatever they might be. But ultimately, it's your plan. It's not their plan, it's your plan. And you're the one who makes the final decisions. Also, typically with business plans is you've got an idea about where you think the market might be going, how many, what market share you might have, how big the economy might get. You've got a view of that, but you typically also will have an idea about what the risks might be to that plan, and you'll build in some contingencies. The difference between the way that people do their business plans and then the way they run the business of their investments is that I find a lot of people will have, of course, an investment plan. They may not have written it down, but they've got an idea about where they think markets are going and what they want to do in order to profit from that and prevent risk. But much fewer people will then start thinking about what could go wrong. What if I'm not right with my assumptions about the future? The advice that I've taken, what if it's off the mark, and what would that do to my portfolio, my investments business, and therefore my lifestyle if it's wrong. And so for the next hour or so, we're going to be talking about not necessarily exactly what you should be investing in, because you've heard that before, but it's what does the world look like today, and in particular, what are the 5 biggest risks as it faces Aussie investors with today's world, and what can we do about that? So we've got our base business plan, but what are the risks that could really knock our plan off its course, and what could you do to reduce the pain if that was to happen, or actually to profit from something being different to what we thought it might be. Now, so as I say, it's going to be quite different to what you may have heard before if you've been to other investment seminars, and I explain that up front because otherwise everyone keeps waiting for the magic answer at the end. I will be specific about things you could invest in, but these are, consider this to be my input to your plan, and if there's one thing you take away from it, it's maybe you leave after an hour going, okay, that was interesting. That made me really think about that particular risk. I'm going to go and have a think about what my portfolio would do if that risk were to come to fruition. So with that in mind, let's get into it. Of course, yeah, everything I'm going to talk about for the next hour is, as I say, it's my view of the world given what we can see today. And you know, I arrogantly say my view because actually there's a great team behind me here, but I'm the one who gets the microphone. So today you're going to hear from me and my view and the colour that I'll put on that. But ultimately, you know, you really need to form your own view. I think it's Buffett who quite famously typically says, never invest in anything you don't understand. And that's the plain English version of what this long disclaimer actually says. So the top 5 risks facing Australian investors. And so for those of you that have already read that slide as we've put it up, you'll see a TBC down the bottom. That is not a typo. That's just to make sure that you don't read ahead and see what number 1 is and go, great, thanks very much, and hang up. We want you to stick around to the end. So we will reveal what number 1 might be at the end. The most important thing to note about this slide is we're talking about the top 5 risks facing Australian investors. I'm assuming almost everyone on this phone call is dialing in from Australia. So you know, on that assumption, what do we do as Australians when we invest? We invest quite globally. We either do that by going into global shares or bonds or property, or in fact, all Australian companies, with very few exceptions, have a great deal of exposure to the rest of the world. So we are global investors. There's not much avoiding that. There's certain economies we're very heavily exposed to, and others that we're not. And really, as I go through these top 5, that shapes how I might rate them. So number 5 for me, the least of the 5 risks, not insignificant, but the least of the 5, is Europe's future. And whether you're talking about the EU's future or the future of the European economy, the same points stick to this point, which is that both demographics and debt in the case of Europe, much like Japan, they're both conspiring to really cloud the future for the European economy. And that has a number of implications. The currency obviously will be weakened in that scenario, but the EU itself is certainly under threat as a result of that. Number 4 is actually the United States. And while the States are going very well relative to the rest of the world, it's a good economic cycle, not a great one. The economic growth is still below average. It still has signs of the wobbles from time to time, but it's actually the strongest economy we've got in the world right now. And we really need it to maintain that strength. We don't need it to be great. We just need it to stay good. And so if that were the case, you know, the US dollar would continue to rise, but if suddenly we saw the US get weaker, the world really is in for some very, very shaky markets. It'd be impossible to have a top 5 without talking about Australian housing. That's number 3 on the list. Number 2 is China. No surprises there. But I am going to talk about the 2 parts of the Chinese economy right now. One that's been forgotten in all the negative news recently is the consumer side of the Chinese economy, and it's quite positive still. But the manufacturing, industrial, construction cycle is probably a bit worse than what you're really reading in the media now. So that's very much a mixed story. Leading us to number 1, which is you know, really what the topic of this whole seminar about, which is the new normal. a low rate, high volatility environment. So we'll spend the last 15 minutes or so talking about why that's number one risk on this list. So getting straight into it, number 5, as far as I'm concerned, the fifth of these, or the least of these 5, but of course it's still a significant risk, is a stagnation in Europe. And I'll explain in a second why we've got this chart up with debt and population growth on it. But when I'm talking about each of these risks, the way that I've ranked them really is to talk about what would the impact be on Australians were it come to fruition. And in this case, the impact's actually relatively minor compared to the US or China having issues, or housing for that matter in Australia. We don't actually have, as a nation, we don't have a great deal of investment exposure to Europe. The probability is another factor. In this case, it's small but growing, heading the wrong way, and the time frame is long term. So if something had a large impact and a high probability in a short-term time frame, that would rank as number one risk. So why have I plotted population change and current debt to GDP on one chart? What's the relevance there? The easiest thing to do is, again, think about it as your business. And if you ran a business and you say had $10 million worth of revenue and you had $10 million worth of debt, there's nothing actually wrong with that exact ratio, right? It depends on the business, depends on the type of debt, it depends on a whole bunch of factors. But all other things being equal, as they say, $10 million worth of debt in that scenario is worse than $9 million worth of debt. That we can definitely conclude. It's the same when you're talking about debt to GDP ratios for a country. GDP is the equivalent of revenue, and debt, we all know what that is. So a country with very high debt to GDP ratio so Japan, for example, is 200%. In other words, they have twice the debt that they do the size of their economy. Isn't in itself a terrible thing, but it's certainly much, much worse than a country that has less than 100% in all cases. But Japan owes the money to itself, so I'd rather be Japan than Greece, the next nearest one on that list, whereas Greece owes money to everyone else and not very good at collecting revenue. So I'd rather be Japan at 200% than Greece at, say, 165. And I'd certainly rather be China or Germany with much less than 100% ratio than either of them, because debt needs to be repaid at some stage. So that's the way to read the current debt to GDP side. If you're below that white line, if you're in the bottom half, so in other words, Italy, Portugal, Greece, or Japan, then you have an above average debt to GDP ratio. And if you're above the line, obviously you have a below average. So that's your business. You've got $10 million worth of revenue, and the debt to GDP tells you how much debt you've got. On the other axis, going from left to right, is the expected population change over the next 15 years. If I'm running a business, this is a bit like how many workers I've got and how many more I can get access to. Right? So in a market where I can't just go and employ more people because everyone's already employed, how do I get access to more workers? And I can't increase my revenue if I can't produce more product. Right? So if I'm in the top right-hand side, where Australia is, thankfully, of this chart, and this is about my business, then I can get access to a lot more workers, and I've got low debt. That's where I want to be as a business. And it's the same for countries. If you have low population change, then you have lower access to workers. There's only one way you can improve your overall output, your GDP, and that's productivity. And productivity, in other words, how much output you have per person working, is very hard to change quickly. You need to improve education, infrastructure, technology, and then you need a bit of luck. So it's far less predictable than population change. So we really don't like to see countries with low population change and high debt to GDP. We don't like either of those, but we certainly don't like the combination. There are a number of countries, and a lot of them are European, at the moment that have negative population change expected between now and 2030. Germany, Holland, Italy, Greece, Japan, Portugal are all amongst those. If you're on the left-hand side of that vertical white line, you're below average. And China has a positive population change expected, but only just, so it's below average. France, on the other hand, is just to the right of the line and expected to have above average population growth. The change of the drop in populations in Europe is quite remarkable. Portugal had less births last year than any year since 1740. Germany's population is dropping at about 300,000 per year. A lot of people ask me, well, is the current crisis with immigration going to change that? Sadly, no. Sadly for everyone involved, because one, that population number is actually not that large relative to Europe, and two, there's already some closing of borders going on. And that's sort of the issue for Europe, is that relative to the rest of the world, they're not migration friendly. And so their population growth from births and deaths is falling, and they're also not letting more people in. And if you've got high debt to GDP ratio and you're trying to get that under control, your economy is already falling, which means that young people leave. And they go to the ones on the right-hand side. France, England, America, Ireland, India, probably not moving so much there, it's just got a higher birth rate, and Australia. And so that's the problem for Europe. Low birth rate, high death rate, low migration, inbound, and policy and cultural biases against migration, and already in a poor economic situation. It does tend to spiral. And if that's the case, the EU will come under more and more pressure. I've got to give 30 seconds to, obviously, to the EU and the UK, otherwise our questions are going to go berserk on this topic. Is it net positive or negative? I put out a quick note a few days ago on this. I think actually overall it's a net positive if the UK does decide to leave the euro, but for the short term it's a net negative regardless because of uncertainty. The world is so full of uncertainty already. Markets are clearly fed up with uncertainty around the US Federal Reserve, uncertainty on equity markets, uncertainty on oil. They've had enough, and just one more thing is not helpful. Not to blame the British, of course they're doing what they're doing, but that's why markets are so upset about it right now, is they're 100% full of uncertainty, and they just didn't need another thing. But if you were to follow what I believe, it's that actually this is probably going to be a good thing for the UK. Even if they vote no, let's not leave, it's still a good thing because they did quite a good deal along the way. And so the fact that the pound has been sold down since then, I think, is a great chance for us to have a look at. Is it a good time to be buying into the pound? So going on to number 4, risk. This is a very complicated chart. The guide, the Smart Income Guide, is coming out soon, and we've got plenty of text to explain this. So I don't want to give it a lot of time. I just want to make a couple of points here. One is that the US is really the backbone of the global economy right now. It is not the fastest grower, nor is it the largest grower. It is the most solid. So China is actually a large, 2/3 the size of the US and growing much, much faster. But it's clearly volatile, and it's very hard to understand exactly how fast it is growing. So markets don't trust Chinese growth. And they need it, but they don't trust it. Whereas the US, they trust it and they need it to stay strong. So what's really interesting about the fact that the Federal Reserve put up interest rates for the first time last December, and why markets are so obsessed with how many more times they'll put up rates, is shown on this chart on the right-hand side. All of those balloons represent how many times the central bank in America, the US Federal Reserve, put up interest rates. The bigger the balloon, the more times they put it up. If you're on the right-hand side of that line, so right at the top there, we've got war on inflation, 1977. If you're on the right-hand side, then you're above average GDP growth, above average economic growth. So clearly in 1977, GDP growth at 5.7% is huge. If you're above the horizontal line, then you're above average inflation. And so again, with 1977 and 1980 on the far left-hand side, inflation was way above average. A central bank will put up interest rates certainly if inflation starts to get out of control. They'll definitely put up rates. But what they try and do, and you can see that most times that rates have gone up by a little bit, has been when they've preempted inflation going up. And normally inflation will be the result of an economy is going really well and it runs out of workers. And then suddenly wages start to increase. And if wages increase, obviously, then costs increase, which push up inflation. So where they start to see very strong growth, they'll tap on the brakes. And the stronger the growth, the more they'll tap. So we've only ever seen one occasion, historically, until last year, one occasion in which GDP growth was below average and the central bank in America slammed on the brakes, and that was 1980, when they'd had enough of inflation. They said, that's it. We are going to stop this. 11.2% inflation, that's understandable. And they really ramped up rates. Really hurt the economy. For those of us who remember that time, it wound up being a global recession, but it got inflation under control once and for all. Until 2015 came along, when we had the lowest inflation rate ever with an interest rate increase and the lowest ever GDP growth rate. And that's why it's so extraordinary and why markets are so obsessed. To tap on the brakes when we've got low inflation and low growth is unprecedented. And that's probably the best word to describe the markets we're in right now. I'm going to come back to that later on.
That's the red dot on the graph, isn't it?
Red dot bottom
you can
left,
see
yeah.
how isolated that is from everything else, and that what a poor position we are for interest rate increases going forward.
Exactly. So when the Fed came out with that rate increase, they then said we'll do 4 more next year, and no one believed them, and understandably so. At that time, we thought they'd be doing 1 to 2 more. The market thought 2 to 3. The market now thinks 0. We still think 1 to 2. Haven't changed our view. Another great Buffett quote I like is, we're paid to be right, not to change our minds. So the US economy is doing well. I think there could be some more interest rate increases there. But what's more relevant as Aussies is how fickle the market can be, and it's gone from one extreme to the other quite quickly in that space of time. More on that later. So number 3, couldn't be a discussion about Australian investing if you weren't going to get into housing. And I always make sure everyone understands when I talk about, I think the probability of a housing correction in Australia is small. I always remind people that my father was a Gold Coast property developer, so I was very much born with the white shoes and the whole bit. So form your own views. I think Australian housing is in a good position. It's probably the worst it's been for a long time, but that's still good because much of the rest of the world wants to live here. Whatever your views might be on immigration, as a property investor, it creates a floor, and it means that we do have some downside protection. That said, what's on this chart with the thick blue line it gives me certainly cause for concern. The chart is the ratio of investment loans for residential property as a proportion of the size of our economy. We put it proportional to the economy because in that 20-year period that we've got on this chart, 1996 to now, in that period of time, the Australian economy has grown extraordinarily. And so if I just showed it as a number, a dollar figure, it would be a steep line upwards and misleading. But there is no excuse for and no rationale for an economy to go from a 25% ratio, so in other words, loans to investors in residential property where it was about a quarter of the size of the economy 20 years ago, to almost 5 times higher 20 years later. We know why it happened. The great economy growing at the same time as negative gearing becoming such a great strategy in Australia. You can see why it happened, but it's not about that. It's actually about why would that be healthy for an economy to see so much money going into property when it could be going into something that grows jobs, and that's really what the red line is, which is loans by banks to small businesses. SMEs just means small, medium enterprises. And your small businesses create most of the job growth in an economy. So that's hard at the same time as 5-fold increase in investment property loans. So there's going to be certainly a winding back, and there already has been to a very small extent of investment lending. If there was a downturn because, say, rental yields dropped and suddenly those investors pulled out, that's when we start to feel some pain. There is no such thing as the Australian housing market. Even when someone says, I've lived in most Australian cities part of my life, but when anyone says the Brisbane property market or the Sydney property market, they don't understand what they're talking about. They're separate markets. So where the pain will be felt in particular is where investment is at its highest, which is places like, if you're talking about Sydney, you're talking about Pyrmont, if you're talking about Brisbane, you're talking about New Farm, inner city when it comes to Melbourne. Where you've seen the most cranes is typically where the pain can be felt, as a very crude rule of thumb, because it's the investors who will leave first. And they'll leave when oversupply takes over from undersupply, because suddenly the renters have a choice and they pay less. Sydney probably sees that in about 18 months, maybe a little bit less than that. Brisbane and Melbourne both went from undersupply to oversupply last year. So they'll be probably the first two markets will experience some pain. Adelaide and Perth are quite unique markets and have their own issues. So with the previous risks, time doesn't permit to go into asset allocation strategy, but now I'm going to start doing a little bit more of that. If there was a housing market correction, crash, whatever word you want to put on that in Australia, one of the best places to be would actually be short Australian dollar. AUD is Australian dollar. And the hard thing to, or the easiest assumption to make when I say short an asset class is we're talking about derivatives. Currency is the one asset class in which you can go short without having to even say the word derivative, because if you've got cash sitting in Australia or any asset sitting in Australian dollars and you sell that to buy, say, US dollars, you just went short the Aussie dollar. By definition, you sold Australian dollars and you bought, doesn't really matter what you've bought another currency. And like all shorts, if the Aussie dollar were to fall after you did that, you would make a profit. So in the case of an Aussie housing market crash, it hurts our psyche, as we know. We're very, very obsessed with property. So that hurts confidence, which would then drive down the economy. So the RBA, the Reserve Bank, would very likely in that case react preemptively and lower rates. When rates go down, a currency goes down with it because it's less attractive to park your cash in that country. So you would quite likely see, certainly the world markets would go, oh, Australian housing, we knew that was, we thought it was overpriced. And so now it's actually into correction. This could be severe. I'm selling my Australian dollars. And you'll see a 10 to 30% drop depending on what the headlines look like. No other currency would be impacted. Similarly, no other equities market would be impacted. So in this case, we talk about reduced Australian equities. If you're worried about the Australian housing market having a slippage, you would reduce your Australian equities, but you don't reduce equities. So go out of Australian equities and go into some global equities. Or go out of Australian equities and go into the corporate bond equivalent, because it's the same company, you're just de-risking from that. Very specifically about Australian, because no other country's equity market in the world would be impacted by an Australian market downturn. Maybe New Zealand, but no other major market would be impacted. A severe housing market correction here, however, would have severe implications for our equities market, particularly given how heavily weighted we are on the banks. Obviously, if you're going to go into national equities, do it unhedged, because then you get the short Aussie dollar at the same time. It probably goes without saying to reduce your bank equity exposure. Our banks are far more heavily exposed to mortgage debt than anyone else in the world. But the less obvious thing is when we're talking about bank equity, hybrids, most of the recent issuance of hybrids, probably for the last 3 or 4 years now, will switch into equity under stress. APRA has the choice to do that. Are under certain ratios, and so a lot of the hybrids under stress actually start to look like or become equity, and so you really don't want to be heavily exposed to hybrids if this is a risk you're worried about. The last one, very few people on the call will be exposed to. Mezzanine debt is lending to constructors, property developers, but you're the lender that sits behind the bank, and you really don't want to be lending money to someone developing units when the housing market ends.
It's interesting, Craig. Just during the week I read about how 2 of the major banks had reclassified some of their loans, and that now the 4 major banks, 40% of their property portfolios in total are to investment property loans. So, that's a big weighting. And APRA's just come out and guided the banks to keep new growth in investment property lending to just 10% a year. Yeah. So that's actually going to tighten the banks, what's been a very lucrative market for them. So that's sort of going to put a bit of a brake on growth in future, I think. So
definitely, that's right. And the other thing with so you get 2 of the major 4 are actually above the 10% at the moment, so they have to go further down. And a lot of people blame foreign investment for pushing up housing prices here. It's still actually relatively small, except when you look in certain suburbs where it's very high. And again, they can be spotted by the cranes on the horizon as well. So if there's a sudden pullback in foreign investment, then you'll see some even steeper falls. I think the two will actually work counter-cyclically. So if there's an Australian downturn in housing and the dollar falls, then actually more money will come in. So it does create somewhat of a hedge, which is why I'm not, as my base assumption, I'm not bearish on Australian property. I just think the returns are going to look pretty mediocre for some time. So getting on to the next slide. So with each one of these, now I'm going to talk about asset allocation as a whole, but then I'm going to drive a little bit further down into specific securities. And in particular, if there was an Australian housing correction of some meaningful description, you really want to be in what we'd call a safe harbour environment. You want to be in a part of investment markets where you're far less impacted by consumer spending, by corporate profits, and one of the great asset classes in this case is infrastructure. And specifically, I'm talking about here not infrastructure bonds only, I'm talking about infrastructure bonds and infrastructure equity. So one of the best performers on the market for the last year has actually been Sydney Airport equity. It's up, I think, sort of about 28% or so. So much so, actually, the dividend yield has been crushed. But it's still a very, very strong performer, even in the last couple of months. And despite the fact that it's equity, it's still a safe harbour. Why? The chart on the right-hand side really gives you an idea. So we've taken, in this chart, the difference in activity volumes. In other words, if we're talking about water, how many litres were used. We're talking about miles driven, that's fairly obvious. We've used the US because the US went from good times to bad very quickly between 2007 and 2009. You can't use Australia for that. And we've said, what's the difference in activity? So in other words, miles driven, the second blue bar from the left, is down about 4.5%. There were 4.5% less miles driven on toll roads where they measure traffic in America between 2007 and 2009. Why do we care? Well, if you own infrastructure, you're paid by how many cars go through your toll. If you own water pipes, you're paid by how many litres you use, electricity, etc., etc. So when we look at economic activity, and if we're worried about, in the case of, say, a housing market downturn, if you're in the corporate sector where there's a bigger impact on activity levels, like the right-hand side being lending, restaurants, construction as three examples, airlines sort of sits out there as well, those sectors were severely impacted in terms of the activity levels between 2007 and 2009. They are very heavily exposed to economic cycles. On the other hand, and actually clothing is sort of in that mix as well, it's about halfway along, but it's about a 12 or 13% drop. People have the discretion to not buy the extra pair of shoes. Maybe my wife's an exception to that, but normally they don't. More extra dresses and handbags, you don't do that at that period of time. But groceries, on the other hand, not impacted because you actually spend less at restaurants, more at home. You have to eat. Electricity not impacted, energy not impacted, health not impacted, even enplanements. It's just a fancy word for getting on and off a plane. Really only down 7% in that period of time. Why? Because oil tends to fall and also airlines get really competitive. They don't have less planes in a recession. They've still got to fill the seats. So ticket prices drop so people travel more. So it tends to be quite buffered.
I was just going to say, Craig, you talking makes me think of Sydney Airport as like a short AUD strategy, in that the AUD goes down, we get more tourists which are coming through. Sydney Airport is the main destination or departure point for international tourists by a country mile. So, and we've actually just seen that with Sydney Airport results, their passenger numbers are up 7.5%, which is fantastic. So it's almost like if you don't have the currency or you don't want to go the currency play, could you think about Sydney Airport as a short AUD strategy?
Yeah, exactly. It's a really good way to look at it. It's not going to be as pure. You won't watch the news and go, oh, look at that, the Australian dollar fell by 5%. I just made 5%, but there will be some correlation for exactly the reason you mentioned. The lower the dollar, the more the tourists. And actually, business traffic goes up when our dollar goes down as well. So it is a hedge from that point of view, which is why we call it a safe harbour portfolio. Naturally, the equity is riskier than the bonds. That's true of any company. So Sydney Airport equity has more risk than Sydney Airport bonds by definition. Bond payers get paid back first. So the safest safe harbour is bonds, but for a lot of people, they need to be in equities because they still need growth in their portfolio. So if you want to stay in equities but you're worried about economic risk, this is a good place to go. And sometimes, depending on where the markets are up to, the equity is actually better value than the bonds, and in other times the other way around. Not long ago, I remember writing, probably actually 18 months ago now, that actually Sydney Airport equity was really good value relative to the bonds because the dividend yield was high fives, but now it's 3.95. So kind of getting hard to justify as an income investor, whereas the bonds have maintained their yield, in fact, slightly up. We like infrastructure, and when we talk about CIBs and IABs, just bond jargon for indexed bonds and index annuity bonds, where their income or their capital goes up with inflation. And funny enough, it's not actually the reason why we like them right now. It's just kind of a bonus that is an inflation hedge built in there. The reason we like them at the moment is low volatility revenue drivers, for exactly the reasons I've mentioned in that chart. High quality investment grade, because typically they're monopolistic. And if they're not a monopoly, then they're a pseudo-monopoly. In other words, Sydney Airport is not a monopoly. Well, good luck trying to open up a competing store next door. Right? There's no land. It's taken us forever to decide. So it's a pseudo-monopoly. No reliance on corporate earnings. So the corporate cycle, like we see in lending and restaurants and construction, very volatile. Not so much with infrastructure. Low reliance on Chinese growth sounds not very intuitive, except for your point, Liz, that the Chinese tourist market has never been stronger for Australia because their dollar fell. And as I'll get to in a moment, actually Chinese consumers are spending more than ever. And strong relative value, by which we mean in Australia you're getting paid very well for infrastructure bonds relative to the risk you're taking on. So we're on to number two. It's a bit scary that the number two risk is a China hard landing rather than number one, but you'll understand in a moment. When we say hard landing, what do we mean versus a soft landing? Soft landing is what we want to see happen, which is China slowly go from 7% to 6% and then maybe level out at 5s and 4s. We want that because China continuing to grow at 10% gets scary. Imagine a Melbourne tram travelling at 200 kilometres an hour through the middle of the CBD. It's big and it's scary and it can't continue at that pace. It needs to slow, and it is slowing, but a hard landing is where it goes from 7% to 4%. There's a lot of argument about whether or not China is growing at that sort of rate. It actually doesn't matter that much. What matters is how fast it slows. If it's growing at 4 now and it continues at 4, we're happy because we continue to earn the same amount that we are at the moment, and 4% is a very healthy growth rate. But if it goes from 4 to 1, that's bad. So it's the slowdown we really don't like. Why does the world fear a China slowdown so much? It seems like it's a bigger risk as far as markets are concerned than even the US slowing down. We've got a few, some glitches going on with this pie chart, by the way. Category name is popping up. The big red category name, in case you hadn't filled in the gaps, is China. So China has been responsible for 46% of the world's growth, the world economic growth in the last 10 years. Nearly half of the world's growth has come from one country, being China. The other category name there that's 0% is Japan. Gone nowhere in all that space of time. And then you can see the US and Europe and India, which I will come back to. I've seen a question pop up in India already, is really coming through as a strong performer. But for the last 10 years, we've relied on China. Growth in China has meant earnings growth right across the world, which has helped share prices right across the world. So if it's suddenly stopped, everyone gets nervous because it means lower earnings for companies, which means lower share prices. That's why we see so much volatility when China sneezes. It used to be the expression, US sneezes, the world catches a cold. Well, there's two people we need to be worried about them sneezing now, and it's both China and the US. So what would we do if we're worried about a China hard landing? It would, again, the best place to be is actually short the Australian dollar. So, and by the way, I didn't mention before, but when I say short the Australian dollar, despite the fact that this is a FIG webinar, there's plenty of ways you can do that aren't bonds. You can, of course, go into corporate bonds in other currencies, but you can also go cash through a bank account, or Beta Shares has an ASX-listed ETF in US dollars, exchange-traded fund, or you can buy property in another country. There's lots of different ways to do it. So the reason in this case you would be short the Australian dollar, though, is the world looks at Australia as being a proxy, a replacement for China. You can't trade the Chinese currency. It's just simply not liquid enough and not reliable enough as a traded market. Whereas the Australian dollar is recognised as being something that will, the Australian economy will benefit from a stronger China, and the opposite applies. So if China looks weaker, people sell the Australian dollar. In this case, in the housing one, I said sell Australian equities. In this case, if you're worried about a China hard landing, you would reduce all equities. There is no place to hide in the world if we get really nervous about China, and clearly we've seen that for the last 2 months. This has been a consistent slide that we've put up in our webinars and seminars now for probably close to 12 months, but it's become very true, certainly August last year a little bit, and then very recently. You would replace that with a high quality credit risk, or you'd simply get out of corporates altogether and go for the safe harbour infrastructure asset. Australian equities would be more severely hit, probably in the shorter term. As I'll get to in a moment, I might actually be more concerned about US equities in this scenario because they're priced for perfection, and certainly a China hard landing is not perfection. It's a no-brainer. You would reduce your exposure to exporters. Really interesting point to stop on here is that markets will always overreact. They'll overreact on the upside, they'll overreact on the downside. And at the moment, it must be said for a number of high quality exporters that there's been overreaction on the equities and the bonds. So there starts to be a point at which BHP is simply too cheap. There starts to be a point at which the bonds have been oversold. And yeah, you pick your point, but certainly we've seen a colossal sell-off in the equity, which may be to do with the fact people are nervous about dividend sustainability, and fair enough. But there's so much cash flow coming through with the big miners. I'm talking about here, your BHPs, your Rios. Fortescue has become one of the majors in iron ore. Glencore is another great example, where the colossal amount of operational cash flow very easily covers the debt repayments, and as a result, why would they be selling the bonds? It's very similar to what we saw with Qantas a couple of years ago. When the Qantas share price collapsed because people were worried about the losses they were talking about, there's so much surplus cash and assets at the time, there was no reason to sell off the bonds, but people did. And a lot of big clients went into Qantas bonds and it did very well actually in a short space of time. Seeing the same thing now with exporters.
They did, that's true, and in fact there's a note in the Wire overnight about Qantas and just what the returns are if you bought at that low point, which they're all double digits on all three bonds. I think it ranges from 11 to 14%. So it's, I think when everyone else thinks it's bad news and the equity markets think it's bad news, that's a time to reassess and look at, is the rate of return on the bonds, does that make sense? Glencore to me is an easy one. You know, recently reaffirmed in the BBB- range, still paying, you know, towards 9% on an AUD investment grade bond. That's like, to my mind, that's an easy yes. I'd have that in my portfolio.
Yeah, and like everything else, look at the mix of things you've got in there. But a BBB- pretty good. And BHP's price when it came out recently with its bonds was very good as well.
Yes.
Everyone thinks of mining when they think of exporters. Watch education and construction as well. You know, very heavily tied to the Chinese market. Less obvious when it comes to China having a hard landing is inflation hedging. Inflation is one of those things where when it's low, and it's been low for a long time, everyone says, why would you even talk about inflation? If this was somehow we managed to do a webinar off our computers in 1969 and we said, you know, you should look at inflation hedging, everyone would have said, why? It's been like flat for 10 years. Well, 5 years later was the worst ever inflation, and the biggest losers when it comes to very, very high inflation are cash investors and retirees, because that's where the inflation really bites in. So if you can find a well-priced inflation hedge like an infrastructure or certain equities, then that's a great place to be as well. So if you're worried about China, then we talk about a short China portfolio. And really that's just the safe harbour or infrastructure portfolio we mentioned before, but mix in that some foreign currency. The sad thing with foreign currency bonds is actually you need to be a sophisticated investor to access it. That's a regulator's issue. We can't do much about that. But you can just replace that with cash or equities in other currencies if you aren't able to access foreign currency bonds. You'll profit from a falling AUD. So it's a short China portfolio because if China really does hit the skids and the AUD falls, which will be tied very heavily together, you'll take a hit on your equities. And of course, everyone holds equities. So you'll take a loss there, but you'll make a gain on this. So it's a hedge. And so the more concerned you are about China, the more you should go into this strategy. I'm very careful to say with these seminars anything about equities because I've had several people come up to me afterwards when we've done the live seminars and say, oh, thanks so much for that, I'm going to sell my equities. And it's horrifying because most people, very few people, don't need equities. Sorry for the double negative. Everyone needs equities to some degree because it's your growth asset. And so we're talking about degrees here. If you're concerned about one of these risks, pick your riskiest equities and switch them into something that's less risky, like less risky equities, or like bonds, or if you want to profit from it, then the currency play. The chart on the right-hand side here is very important to understand that all of the negative news about China at the moment is well placed to point out that certain parts of China are really hurting. So the credit cycle in China has played out. It was very easy to get access to credit. A lot of people borrowed a lot of money and built assets with it. They built factories, they built houses, which we famously heard about, they built infrastructure, and there's overcapacity. And the manufacturing overcapacity is hurting the whole world, and that will go on for some time yet. But the consumer sector in China is still growing at over 10% per annum. And this is an economy 2/3 of the size of the United States. And the consumers are still spending 10% more each year. So if we heard about 6 or 7% consumer spending growth in the US, we'd be so excited. Same thing's happening here effectively. Cinema participation, up 48% last year. They sold more movie tickets in China last year than US for the first time ever. Cheaper price, but only we're talking about $8.30 versus $5.16 in US dollars, so not a big difference. So there's some phenomenal growth in the consumer sector there, and it'll be very easy for assets to be oversold in that space.
It really sounds like they're going from that market-based economy more to a leisure consumer. Like they're starting to enjoy some of their wealth and spending it on themselves. And but I know they're very big on brand names, for example. So some of the luxury brand names have huge earnings from China.
It's the largest luxury brand market in the world. It's past the US and Europe on luxury, and things like cinema and discretionary goods will be next, and food will follow closely behind. So if I could invest in China and take my investment and put it in the drawer and not look at it for 10 years, it would get the majority of my money. But we're human and we do want to pull it out and look at it, and it's so volatile that it makes it very hard. So you take your own balance and understand, but just make sure that keep an eye on China because it is going to be and will continue to be an exciting economy. And if Australia can attach itself to Chinese consumers as much as we did to Chinese construction, we're going to do very, very well. So number one, and I've got 10 minutes to do this justice, and then, as I say, we'll stop and we'll go back through some questions that Liz has been pulling out. The biggest risk is not the scariest risk. The biggest risk is number one, simply because its impact will be medium, so not as severe as a China hard landing or housing would be, but its probability is high. So in my mind, and as I get to on the last slide, this is like the 80% scenario. This is what I think is going to happen. And the time frame is, well, it's actually now. It's already happening. The new mediocre is not our term. It's Christine Lagarde. She's the Managing Director of the International Monetary Fund. Very, very smart lady. Just voted back in, thankfully. They forecast global GDP growth and each country individually each year. The reason on this particular chart I have shown their forecast versus actual is to make a point about human nature. So we know that Wall Street will be biased because they're paid to be biased, right? If you haven't figured that part out yet, then there's a fair bit of reading to do. But there shouldn't be a bias with the IMF because they're not paid by any particular asset class. And yet, every year since 2009, and further back if you go back, but since the GFC, the IMF has got it wrong in the one direction. They've been too optimistic. So the light blue bars here show their forecast at the start of the year, and then by the end of the year, the dark blue bars show the actual. So straight after the GFC, they thought 4.6% growth is what we would see. We got 4.2. The following year, they thought, oh, we'll go wrong the first year, we'll go again with the same number, and it went worse, 3.4. They doubled up the next year and increased it, and actually it got worse again. Then they started to reduce their forecast, but every single year they got it wrong. And if you flip a coin 7 times and get heads 7 times, it's a pretty remarkable outcome.
Well, what's amazing is they've just lowered their rate for this year already. It's February. Yep. It's February. So they really, what, 6 weeks they've given themselves, oh, we've called it wrong.
Yep.
Really? Well, you know, 6 weeks? Come on, guys. You know.
And that's been happening every year as well. So, of course, by the end of the year, they get exactly right. When they forecast in December, and it's already December, and, you know, it's strange enough they get it more or less right. The point of this slide is to point out one of the most fundamental truths in investing is that humans are, by our nature, optimistic. It's in our DNA, otherwise we wouldn't have got this far, we wouldn't have tried all the crazy things we've tried. And so if you understand that, then you'll understand that markets will typically bias to the positive. The same sort of thing, you know, and this will be in the guide, but when you look at Wall Street's forecasts of growth and bond yields and equities growth over time, in fact, you can go back like 12 or 13 years and they've always got it wrong to the optimistic. You flip a coin 12 times and see if you can get heads, and I'll call you a liar. It's impossible. So, I just want to touch on that point again because it is so important to understand in an environment in which we believe that economic growth will be below historic averages, in other words, mediocre. Why do we need to understand this point about human nature? Because we will constantly hear headlines like, finally we've bottomed out, it's going to turn around. And we've heard this for the last 5 years. And you need to understand that by and large that's going to be overly optimistic. This chart, ignore the red line on this, that can be explained better in the guide when you can see the words. The one to really focus on this chart is the blue bars. The blue bars represent the forecast at the start of each year of earnings growth across the whole of America. All right, so 1988 is the far left-hand bar. It's almost 20%. In other words, that year, at the start of the year, the average Wall Street economist, analyst believed 20% earnings growth was going to eventuate. The higher the earnings growth, the more you should buy shares. That year, funny enough, they were actually under where it came out, which is actually 30%. Two things to notice from this chart. Every single year for 26 years, the average Wall Street economist expected earnings to go up. Anyone who's run a business for 26 years, if you get earnings growth for 26 years in a row, that's remarkable. How is it that every single year they believe it's going to go up? And not just that, the worst year forecasted was 9.5%. And it was 1990, the world was fairly grim. They still thought there would be 9.5%. So the average forecast has been double the outcome. The average forecast has been nearly 12%, the average actual has been 5.5%. It's this persistent bias to the irrationally optimistic. Exactly the same trend as you mentioned before, Liz. We're in February and already every single major bank has slashed their earnings forecast for this year. 2 months in, not even that, and already they're slashing it. Why? Well, because they didn't read the tea leaves that the world economy was much poorer, and it's been fairly obvious for a long time that it's much poorer than everyone believed, and suddenly they're adjusting their expectations. And that's one of the most important points with the new normal, is our transition from believing that QE was going to, I'll come back to what QE is, it was going to turn around the world, has inflated equities prices, but now as we start to go through this transition to people going, oh, okay, it is going to be a bit flatter than I thought, equity prices in particular need to come down to adjust to that. And it's the US I'm particularly concerned about because it's the most overpriced.
But they haven't really got to where they are going to end up, have they? You know, they're still adjusting and adjusting down slowly because they really want to still be optimistic.
Yep.
So it's, you know, we see low rates for a long time, very low rates. But, you know, we've been calling that for how many years now? 3 years?
3 years.
3 years.
In fact, yeah, the bond markets are about right. Where they are now, they're sort of starting to price in the US in particular, not Australia. I think Australian bond yields are still too high. so there's still some money to be made there. But in the US, it's about right at the moment, where the bond yield's about 1.75%, meaning the interest rates will go up to 1.5 to 2% in the US and settle there. Only a year ago, they were a whole % higher than that. So really, the bond markets have caught up, but to me, the equity markets have still got a good 10% downside at the very least, and probably a little bit more. And if you want to see evidence of that, AFR headline 3 or 4 days ago was a classic. It read, Japanese equities up on weak economic data. The headline basically was saying the Japanese share market went up because everyone went, great, weak data means more QE, more quantitative easing, more cheap debt. And that is the single biggest problem we've got with this transition period, is all of this cheap debt, quantitative easing in the US first, and then Europe and Japan, and arguably anyone who's lowered interest rates like Australia, has created a bring it forward effect where equity markets have started pricing in future growth well ahead of time, and they've effectively borrowed from future gains. And that really has to be corrected. And the longer QE goes on for, actually the worse that gets. So I look at that weak economic data and say, oh no, more QE in Japan, that's bad, because it's just going to make any overinflation bubble, if you want to use that word, worse.
It's just an addiction though, isn't it?
It is.
You know, it's hard to wean yourself off that addiction. Equity markets, governments,
yep. So all through 2015, Wall Street went up on bad data. Now that the Fed has finally moved in the US, Wall Street goes up on good data. Right? That Japan and Europe are still in that old cycle, and that's very, very unhealthy. So what do you do about that? What do you do about the new mediocre? I think, funny enough, there we are again, short AUD. Why does the Australian dollar cops up to hammering from us in this? The Australian dollar is a growth proxy. So when the world grows faster than average, then they need more of our things. They enjoy the tourism and education, but more specifically commodities. No surprise. They need more stuff to build when the economy is going well. So when it's going less well, then our currency tends to slip, which is why 18 months ago we were very strong on saying the Aussie dollar simply can't stay at this level. It doesn't make sense, and we've really seen that play out. Reduce US equities. I've picked on them because, as I say, they're very overpriced. They're priced for perfection because of cheap debt. The correction could be pretty strong, and we've already seen a big chunk of that at the start of this year, but there's a fair bit to go. Aussie equities actually at reasonably good values. They're probably at average values. Given we're talking about below average economic growth, there could be some downside. The flip side of that is, with everyone chasing yield, it does tend to hold up high dividend paying stocks. So you just want to be looking at low dividend paying stocks or companies with paying too much out, because they're the ones that could cop a slash in dividends, and they'll be very, very severely punished by the market. In fact, I think a lot of BHP's share price drop is preempting their inevitable cut in dividends next week. You reduce short duration government bonds, not because there's any risk there, you're just not getting paid anything. And in fact, Japan, they'll charge you. If you put $100 down now into a Japanese 10-year bond, at the end of 10 years, they'll give you back $100.15. Last week, it was actually negative. They'll take some of your money away. Not great value there. Increased corporate bonds. In worse than average economic markets, bonds outperform equities. So if we slash it up into 5-year period, and we've got a chart on this in a moment, but when we start talking about different 5-year periods, in fact, corporate bonds more often than not does better than equities, but it's when markets are going well, equities absolutely outperforms bonds. So across long periods of time, you'll get more out of equities, but the volatility means you get more out of bonds in these weaker markets. Reduce your reliance on cash. I have personally more money in cash than I've ever had before. I don't mean dollars, I mean as a percentage. But I'm not reliant on cash. So I don't need cash for my lifestyle. I'm sitting on the sidelines waiting for good opportunities to jump in, like resource stocks, resource bonds. But if you're reliant on cash and you go through 10 or 20 years of low interest rates, it's going to hurt. And particularly when inflation is going to look like more or less the same as that interest rate that you're getting on the deposit, you're going backwards. And hedge against inflation for the reasons I mentioned before. So the last portfolio we talk about is the diversified high yield portfolio. This one has less hedging in it and has actually still got some probably a stronger yield than the safe harbour. It's a very benign, well-diversified portfolio. You're still going to get a good yield out of a diversified high-yield portfolio. It's a way of maintaining your income but taking the equities risk off the table. We say diversified because in a slower economy, weaker companies are going to be more suspect to having some big declines. That's true of equities or bonds. So diversified high yield means maybe 10 or 20 high yielding bonds giving you 5 to 7% depending on which ones you pick. Go across all sorts of different economies. And over, as the chart on the right hand side shows, that really boring red line is bonds and the blue line is equities. On average, across the whole of that 15 years, you're better off in equities. But in 55% of the 5-year rolling periods within that, you're better off in bonds. And this is one of those times where if you believe that the economy is going to be slower than average, then the bonds will outperform. So we've got some more glitches going on with the technology here. The new normal portfolio, if we start to wrap all this up, what does a portfolio look like? Of course, this is one area where I can't be specific because everyone is different. But let's talk about if you're more nervous about China, then you'd shift more money out of the Australian dollar and into US dollars or pounds. So this strategy is actually about being out of Aussie, but then you've got to go into something. And US dollars to me and pounds, British pounds, are the two best currencies, two of the strongest economies around the world, despite whatever might happen with the EU. The UK economy is doing very well. And the alternatives of euros and yen is pretty hard to buy. So if you're out of Aussie, go into those currencies. The more nervous you are about China, the more you should put in there. If you're just looking to de-risk overall, you're really looking for a safe harbour, infrastructure bonds, and that could be anything from 30 to 60%. You don't need to diversify as much with infrastructure bonds because they're very highly rated. But if you're just looking to de-risk but maintain your income, and really it's not that you're worried about the big risk, but you just recognise the world is slower than it's been in the past. I would need to be able to get some returns and keep my income up and take some equities risk off the table, then look at that diversified high yield portfolio. So wrapping it up, on the way through we've talked about all sorts of different asset classes. The reason number one risk is the new mediocre is, as I said, I think personally this is the highest likelihood. It's 80%. Why 80, not 90 and 70? It's a number. I don't have a crystal ball, but I think it's very hard for us to see from this point that the global economy could do anything over its historic averages. In fact, it's hard to see it being even close. And there's 4 things really working against that we've touched on during the last hour. Debt and demographics. Fiscal debt, very high for a number of countries. They have to reduce it. That means they have to spend less. No voted-in economy, in other words, no democracy, can cut costs that quickly or raise taxes that quickly. They get voted out and it's ineffective. So they have to do it slowly. So that's going to take 10 to 20 years. Demographics, baby boomers aging, and young people leaving a lot of these weaker economies. Again, that's not a fast thing to fix. If there is a fix at all, it's a generational 20 to 30 year cycle. Emerging markets that have lifted us, as we saw on the pie chart, for the last 10 years are no longer able to do the same degree of lifting. That's not going away anytime soon. The only trend that's much shorter term is the end of QE and cheap debt, but even that could be a 5 to 10 year cycle. So those 4 things conspiring make it very hard to see how we're going to be able to outperform in the next few years. In other words, for GDP growth around the world to be above average, I think it'll be well below. The China hard landing risk I've got is at 30% because I don't think that's actually the base case. I think the base case is they're very, very highly managed, I'm avoiding saying the word well, but so far pretty well managed, 13 5-year plans in a row that they've done what they said they'll do. This is not a philosophy discussion, it's not about democracy, but the advantage of not being a democracy is you want to build a bridge, you build a bridge. You don't have to worry about who gets hurt along the way. Sad for society, great for investors. So it's actually relatively predictable, and hopefully the Chinese economy can avoid a hard landing. That risk for me has crept up from 20 to 30, but it's still the right side of 50. If you think that it's a higher risk than that, then you would shift more money into other currencies. An Australian housing market downturn again. As the son of a Gold Coast property developer, I'll put 20% on there, but you need to understand that that's in my DNA. You might have a different view, and if you did, Aussie dollars, sell, banks, have a look at your exposure, hybrids, have a look at your exposure. Just a few numbers to wrap it all up. With the US dollar versus the Aussie dollar at 71.5 at the moment, our view for a long time has been 65 to 70. It still is. It's probably at the lower end of that range. Sort of doesn't matter as real people, investors. We don't care about small moves. It's 10% that's going to move. If China has a hard landing or there's a housing market downturn, it's going to fall into the 50s. Interest rates in Australia at the moment for 10 years, still quite high. There's still a big difference between Australian interest rates and US. I don't believe that can be sustained. If you're able to go into bonds in Australia, anything from 3 years or longer, you're getting good yields at the moment. And as we saw in the US, they won't last forever.
And as you said, the infrastructure bonds, you know, they have those strong cash flows. People are going to keep driving on roads. They need power. They need, you know, they want to travel, or those are the sorts of things that highly recommended, and that's what we would suggest. Yeah,
that's right. Certainly the thing with, and you'll notice through this, we don't go and name specific bonds. We might have used some examples, but the thing to know with bond markets, particularly in Australia, is from time to time certain bonds will become available at good yields. And so if we were to name them all, then tomorrow they might not be available anymore if there's no sellers coming through. So we avoid specific names, and instead we leave that to the FIG representative, the dealers, because they're the ones watching the markets day to day. We set the strategy level and then let them pick the specific ones. But infrastructure bonds, typically very long dated as well. So the great thing is you can lock in your income for several years.
And as we expect low interest rate environment, locking in and having those known returns should outperform over the longer time, as should the price on the bonds.
Yeah, exactly. In terms of equity markets, for me, the S&P 500 or Dow, whichever one you want to look at, is at least 10% overvalued still, and there's going to be some pain there this year. The Aussie will probably feel the pain at the time. Aussie equities probably feel the pain at the time, as it always does, but actually it's not that massively overpriced right now. Certain stocks, however, will take more of a hammering if there is a sell-off, and others like the infrastructure stocks will probably do a bit better. If you're in Chinese equities, good luck, as always. Japanese equities is very popular with Australians. It's gone absolutely nowhere now for 17 years. I can't see it getting better than that. In fact, it'll be worse. It's gone from 16,000 to 8,000 to 20,000 back to 16,000 in 17 years, and we're going to see more of the same. Europe will look a lot like that as well. I'm trying to think any markets that I've left out along the way. US interest rates I mentioned before, pretty well priced right now, and the same with the pound. The pound at the moment is probably somewhat oversold because of this sort of fear around the referendum. It's been overdone, so you're getting pretty good value right now on switching Aussie dollars into pound. 51.5. It's the first time it's been above that 50 mark for quite some time. One last thing I haven't mentioned actually, sorry, is oil. Talk about a roller coaster ride. There's been something like 2 or 3 business days since Christmas in which oil has moved by less than 4%. It's absolutely out of control. The market is going to be very concerned about supply. Iran comes online very soon, and if they follow through on what they're saying they're going to do, they will increase the oversupply in oil by 25% by the end of this year. So if we don't see someone back down from this war between OPEC and the US, then oil's in for a very, very bumpy year. If you're not out of oil exposure right now, particularly in equities, then have a really good look at that one.
Does that start to play into a deflationary environment? Because to my mind it does. And again, what sort of things would you suggest if that starts to play out?
So talk about US inflation for the moment, and even though we're Australians, I'll mention why that's relevant. Oil being low in the US is deflationary. The US economy doesn't have a lot of inflationary pressure, so yes, it's deflationary, which really probably just means very low inflation, which means lower interest rates in the US. Deflationary in Europe, where growth is very low, and in Japan, which is a problem for them. In Australia, there's a counter effect, which is the lower oil goes, the lower expectations about growth, which means the more the Aussie dollar falls, which means we get an inflation on imported goods. And so we haven't really seen that yet because people were buying, and businesses were buying their goods, importing them over a year ago when the Aussie was higher, but now that inventory's run out. So we're starting to see a bit of inflation pop back in now. We're not going to see hyperinflation in Australia by any stretch, but we will see some spikes in inflation caused. So it's always a good time to look at whether or not you can get some hedges on that. Oil is notoriously difficult to forecast because of there's really only a very, very small number of people, like less than what you can count on two hands, who actually drive the supply at the end of the day. And the world is very much held hostage to that right now. So it's going to cause volatility for all markets.
Okay, I'm looking at the time. It's 11 minutes past 2 by my watch, and we said we'd finish at 15:15. So a couple of quick questions. Property just keeps coming back, and the questions are peppered with property questions. One particular question from Martin. What's your view on residential mortgage-backed securities in the event of a housing downturn?
So, great question, and I actually had that in text but didn't mention it. RMBS, residential mortgage-backed securities, are relatively complex. If you want to know more about them, Henry Stewart within our team here is one of the best I've ever heard talk on this topic. But you know, have some Coca-Cola or coffee beforehand because it's complicated. They range from very heavily leveraged to very secure. So in the event of a, say, a 20% downturn, pretty substantial by Australian terms, never happened, then there'd be a whole range of those RMBS to be absolutely fine, and it would be sort of the bottom, the riskier end that would be more impacted, and Henry can give you the closer sensitivity. The great thing with RMBS is you can more or less pick how much of a downturn you can sustain, give or take, and so you can choose what type of risk to go into. I wouldn't call say a B- rated RMBS a safe harbour asset, but it's still much safer than a construction company equity, for example.
Or perhaps a straight investment in a single property.
Oh, well, certainly, yeah, because you've got diversification.
Risk. But there are a lot of inbuilt securities in RMBS that are worth knowing about, and per issue that you would look at. Yeah, it is a whole issue in its own right. A couple of other things. Another question we had was about inflation-linked bonds, and what about floating rate notes as another option for protection against inflation? Do you have a view on that?
Yeah, FRNs are not, floating rate notes are not a perfect hedge against inflation because if it's kind of hard to imagine right now, but if the Reserve Bank got worried about economic growth being too high, they would put up interest rates, the floating rate notes, despite what was going on with inflation, which would actually be great, but it's not an inflation hedge. If they were worried about a downturn, even though inflation was okay, so for example, if the housing market took a hit, but inflation was still up because of imported goods costs, they'd put down the floating rate notes. So in fact, you're actually going the wrong way. Inflation may be the same or higher, and you've actually earned less income. So the best hedge remains the two types of infrastructure bonds, and a very limited number of equities are quite strongly inflation hedge as well.
And very quickly, do you want to just have a brief conversation or a few words about India? There's lots of questions about India.
Yeah, there's always lots of questions about India. I was on the board of an Indian wealth management company, was at Macquarie, so I had 25 trips to India in a 6-year period and really saw some quite extraordinary growth. The single biggest difference between India and China is India is a democracy. And so, I spent several times 3 hours in traffic going from one office to another that were 8 kilometres apart. And you couldn't get out and walk because it was so hot you wouldn't. And that's really what's holding back their economy. In the longer run, however, India is a fantastic investment because they, unlike China, have population growth for a whole host of reasons. They're also younger. So they will have a working population much larger than China's 30 years from now. Most of us don't really invest over 30 years. That's starting to really get out there, okay?
Yes.
That's the definition of optimism. So I wouldn't be investing in India right now, but I am optimistic about Australia's outlook for my kids, knowing that India's growth is just around the corner for them.
Excellent, excellent. That comes close to concluding the presentation, and we've hit the 3, I should say, instead of 2. It says 2 on my computer. Craig, what an amazing presentation. You've really stimulated a lot of thought. I would think from the questions we've had in it, I can't possibly ask you all of them. I do want to say the Smart Income Guide will be out in the next week or so. We're putting final touches, edits onto it now. It's a very significant report. We'll run to about 50 pages and perhaps provide a bit more detail that we weren't able to go into today. We'll certainly let you know when that's available. Thank you very much for joining us. There will be a recording. We have recorded this presentation, and we will send you a link so you can listen to it again. If you have any questions, put them through to your dealers. They should be able to help, and certainly look out for that report. Thank you very much for joining us. Thank you very much, Craig. We really appreciate your time and your insights today. Good afternoon. This now concludes the presentation.